Scarcity markets are the rule now. Insanity rules markets for everything from oil to wheat to rice right now. In fact, insanity is the new normal. Example: why should oil sell for $119 a barrel? A $55 increase, or 86% higher than it did last April. Is the United States suddenly out of oil? No. March crude oil reserves in the U.S. were actually 2.4 million barrels higher than reserves in February, and only 3.4% lower than reserves in March 2007, according to the Energy Information Administration. An 86% jump in oil prices because reserves fell by 3.4%? No, there's something wrong with that picture. The global picture is similar. Global oil stocks held by developed economies came to approximately 2.58 billion barrels at the end of March, almost the same as at the end of 2007. Global supply and demand is tight and getting tighter. With the latest projections from the International Energy Agency showing supply at 87.3 million barrels a day usage and demand at 87.2 million barrels. Very tight, but supply is still barely ahead of demand. But that will change. Don't stop with oil prices. Look at rice, which recently topped $1,000 per metric ton. The price of export quality rice is up 173% in 1 year, even though global rice stocks will finish 2008 about 1 million metric tons higher than at the end of 2007, according to the U.S. Department of Agriculture. Or copper, for instance, which is setting record highs just about every day and has climbed in price by 30% so far this year. Or aluminum, up 28% this year. Or wheat or corn, you name it. Why the normal rules don't apply anymore. There are many explanations. Demand for this or that has soared due to growth in developing nations, increasing production of biofuels or whatever. And supply has stumbled due to miner strikes or an electricity shortage or a drought in Australia. But this is not a normal economy anymore. It's all based on scarcity. Scarcity markets play by different rules. The global economy is now playing by different rules. The rules of economic scarcity and the rules of scarcity say the normal relationship between supply and demand and prices doesn't hold. Prices are insane. This kind of price insanity is exactly how a scarcity economy works. That is crazy. The concept of scarcity is central to the economics of normal markets. Most goods, whether cars, peanut butter, or rice, they don't exist in unlimited supply. The market supposedly rations those goods at prices that match supply to demand. Scarcity markets exist because buyers believe the normal rules of supply and demand have broken down. Buyers in a scarcity market don't believe higher prices will depress demand or increase supply enough to allow supply to meet demand. In such an insane market, Prices are driven by fear that there will not be enough supply at any price. A fear-driven market is what we have nowadays. For example, companies that need copper to make electrical machinery, wire, or pipes bid prices higher because they worry that current prices won't bring supply and demand into alignment anytime soon. They fear they won't be able to buy copper at any price when they need it. Scarcity markets aren't created overnight. Potential buyers need to be blooded by repeated experience on both the supply and demand side. Consumers of copper now know that for each of the past 6 years, the copper industry has failed to deliver any increases in supply. In 2008 and 2009, the industry will fall short again, with a shortfall of 800,000 metric tons over those 2 years. A sense of inevitability. In the oil industry, major suppliers that were being counted on to increase production have announced production declines. Production fell at least 1% in Russia for the first quarter. And suppliers who are being counted on to stabilize production have announced even bigger shortfalls. First quarter production in Mexico has dropped almost 8%. This helps establish scarcity economics as the rule of the markets if potential buyers become convinced that higher prices will not dampen demand. That happens fastest in markets for goods that buyers especially need to survive. Most Asian consumers of rice, for example, they don't have the choice to eat less without running a real risk of hunger or starvation. And there isn't a substitute for high-priced rice. What are people supposed to do? Eat more, even more expensive wheat or corn? The most profound effect of scarcity economics on prices comes in markets where buyers who were convinced that higher prices would cut demand come to believe that higher prices have little effect on demand. This has happened in the oil market in the past year. Oil at $80 a barrel and gasoline at $3 a gallon were supposed to cut demand and bring prices back down, but they didn't. Judging from the futures market, where oil trades above $100 a barrel as far into the future as the eye can see, potential buyers believe today's high prices won't reduce demand anytime soon. And because demand for oil hasn't declined, oil people now worry it will take a run above $180 a barrel before price reduces demand in some kind of way. Once a scarcity market is established, it produces behavior by buyers that can lead to the very scarcity they fear. The fear of it all. Hoarding, for example, can empty shelves. Of course, the emptying of the shelves themselves create panic buying that just empties the shelves even faster. This is about panic and fear and, of course, greed. Security at any price. And by taking supplies off the market, hoarding produces shortages. Scarcity economics also turns the relationship between low and high cost producers upside down. In a normal market, a low cost producer sets prices low enough to sell out all of production and high enough to maximize profit without decreasing demand and endangering sales. In a scarcity market, the high cost producer sets prices because buyers who fear they won't be able to get the goods they need will pay almost any price to ensure themselves of supply. These are more signs of the end times.